Welcome back. This afternoon, you're listening to the Todd Laborowitz Show, Real Estate Radio and Salem Broadcast Network, WRC 1260 AM. I'm your host, Todd Laborowitz, and we're speaking with part 2 of Jim Musgrave from Research Financial Strategies. Well, Jim, we talked about retirement planning and how you need sources of income other than Social Security to maintain your standard of living when you're in retirement.
Right.
Now, a big part of your income in retirement is going to come from your investments that you saved. There are many ways to manage money, and none of them are perfect. There's books out there. There's people on TV.
Yep.
Everyone's telling you what to do, and so forth. What investment strategies do you use to help your clients reach their goals?
That's a great question. Going back to that last segment, I talked about figuring out what your retirement gap is. So when you plug in that information to the calculators, the calculator says, I want put in a rate of return. So let's say you put a 6 or 8 or 10% rate of return. That's like a fixed rate of return. The reality is that markets don't act that way. Okay, if you go back to 2000 and 2008, we had some pretty big recessions. So one of the things I talk to my clients about is that you need an investment strategy that is going to make money in good markets, but you also need something that's going to protect you in down markets. And I'm going to give you just some scenarios, and so I'm going to kind of set the time frame or the mindset here. If you go back to January 1, 1990 to March of 2000, okay, and you put in $100,000, the market grew 455%, so you'd have $455,000. March 10th was the beginning of the tech wreck, and the bottom of the market was March the 9th, 2002, and that's when the market lost $9 trillion in 31 months. Okay, we all lived through that. So the Dow Jones was down negative 37, the NASDAQ was down negative 79%, and the S&P was down negative 49. And so if you were a 65-year-old who went to retire in March of 2000, you'd be facing a 47% decline in your portfolio. Bad timing, but we can't predict, recessions. Okay, so that's an issue that retirees face. So if you retired at the beginning of a pullback or the beginning of a bull market, that could dramatically affect how your portfolio is, right?
But question for you.
Sure.
When people have the money in the stock market and they're about to retire, aren't they supposed to pull it out like 10 years before they're going to retire?
No, you're supposed to ultimately get a little more conservative so you can. There's a number of different ways that you can deal with your portfolio actually when you're either approaching retirement or actually in retirement. First of all, you want to have a decent amount of cash on hand to actually pay your bills and maybe a year's worth of cash or CD or cash equivalents. You also want to have more income-producing securities such as bonds. You could have REITs. You could have things that.
So you're spread out. You're
spreading things out.
Okay.
So you're reducing your risk, but you still need to have some growth.
Okay, so in your example, it's not their whole nest egg.
Right.
I just want to make sure.
Yeah, no, that's a great question. Good to clarify. So if you look between 2002 and 2007, the market went up 101%. But a lot of people were so shaken by losing so much money in the last recession that they got in late or they missed out on a huge opportunity. Then October 2007, the S&P was at 1565. It dropped 57%, and March the 9th, 2009 was the bottom. And so that was another huge hit. And since then, up to this point, that the market's up over 190% since March of 2009.
Okay, so we have the ups and downs.
We have the ups and downs. And so the question is that how do you deal with that? And so I give a number of investment seminars. One is called Beating Wall Street, How to Beat the System That's Stacked Against You. And I talk about 5 different reasons why people lost so much money. One is that people just don't understand investments, and they tend to time the market poorly. They tend to get out late, and they tend to
well,
get
isn't
in
it
late.
usually they get the information late?
Yeah. As the consumer starts to feel good about things, that's when the professional money managers start to get nervous, and that's kind of what's happening right now. But I can also put a part of the blame on my industry, the financial industry. Okay, and I'll give you an example. If I sold you, Todd Laborowitz, a C-share mutual fund, and I get a 1% trail on that for my compensation, and we have another 2008 situation, and I say, Todd, go ahead, we need to get out of the market. What does that do to my revenue? It's like, it's done. It cuts the revenue to the mutual fund company, cuts the revenue to the broker-dealer. So there's a financial incentive for advisors to keep their clients invested 100% of the time. which isn't necessarily in the best interest of the client. And so what we do is we're a fee-based firm, and so if we need to go to cash, we'll say, Todd, listen, the market's changed, switch from offense to defense. We need to be more conservative. Let's increase your cash position to preserve principal until we have the market starts turning around again.